Hey, how's it going, guys? This is just a very quick video overview of our corporate bond fund and why we did it. We need something that beats inflation, maximizes safer returns. You guys know that a lot of people don't invest in bonds because they're so safe. They usually give pretty low returns, but there's a way to overcome that. So first, what are bonds? It's pretty much just like a debt obligation. Imagine if you got a loan from the bank for your home, that's considered a bond as well. And usually when you do a bond, all the money is returned upon maturity. So there's a date, like 30-year fixed note. At the end of 30 years, needs to be paid off. They can be fixed income, and they could be secured or non-secured, or they could be variable rate. So in this presentation, we're only doing fixed income and secured bonds. So secured by something, not floating in the wind, and fixed rate means your return on an annual basis not going up and down. Here's some examples of bonds. You guys already know about Fannie Mae, Freddie Mac. That's called the agency bond. You guys have heard of T-bills? That's a government bond. There's also municipal bonds. Cities and states use this to raise money for cities. We're dealing with corporate bonds where money is being raised by corporations to either fund operations or to grow. So why are we doing this now? It just happens to be the second best time in half a decade to do bonds. If you guys watch the news, everybody is very bullish on bonds. People are selling out their public stocks and moving into bonds because they're getting higher returns right now. And you can diversify your portfolio, de-risk your portfolio, and beat inflation. And as you guys know, bonds usually have default risk of less than 1%. Here's a little unknown fact. If somebody had invested in the high yield corporate bond strategy, this is the blue line, since 1989 to 2020, you would have beaten the Wall Street average stock fund. How is that possible? What people don't take into account when you're in the stock market and you have these dips right here. So here's a dip. I don't know if there it is. And then here's another dip. Hold on. Well, it's right here. You see the two dips. I mean, from here to here, this is like almost 13, 14 years of almost no growth. You're just catching up on dips. And guess what's not on the chart? The 2022 dip. So if you follow this trend line, bonds is going to beat this thing. So that's kind of crazy. And it's not some niche thing. It's a $46 trillion market. Do you know how big the S&P 500 is? 34 trillion. It's actually 66% of the size of corporate bonds. You guys already know the benefits. You can invest in different bond types, lower risk, less volatile. Basically, there's no volatility. These are fixed income. You get stability to your portfolio, reduces the impact of market fluctuations, and all that good stuff. The problem is people can't access corporate bonds. These are usually given to institutions. They can write $250 million checks, 50 million, 25 million, things like that. We've solved that problem by focusing just in Texas and certain sectors of corporations. And so we got the expertise to do it. I put together my team of experts. We're diversified. You can actually customize the bond, which is something you usually can't do in other types of bonds. And you're going to have transparency through an investor portal. And we're pretty competitive. So how competitive are we compared to other bonds? Well, we start at 8%, and the next best thing being offered is 6.5%. And whereas the corporate income bond fund is right around 5%. And that's just where we start. Now, how can we offer these types of returns? Well, first, there's no brokers. In fact, I don't even make any money in the bond fund. So we have to go out and actually charge points or consulting fees as we offer the bond fund money to corporations. We also negotiate with them. Most people are not negotiating. They just put out some product and whatever happens, happens. We're also going direct to the source, and we're cutting out overhead associated with banks. So now you can get monthly coupons, or you could compound your returns. There's multiple year options, 2 through 7, and there's different interest rates you could get, 8, 12, or 14%. A little bit about me. Some of you guys already know me. If not, My name is Amir Baluch. I'm a contributor to Forbes. I've been featured in a couple of journals, magazines, ABC News, things like that. Over a decade experience in securities and private equity. This number is kind of old, but we're approaching close to $1 billion of projects that I've been a part of. And my brother, he's pretty big into real estate. He runs our real estate development company, actually, and he has over 100 million in assets under management for him. Degree from UT. He's gotten a couple of awards as well. But enough about us. Let's talk about people that are smarter than me and people that are smarter than my brother, right? Warren Buffett, John Paulson, Ray Dalio. Bonds are a great way to preserve capital. Bonds should be part of every portfolio. Bonds are a vital component to most portfolios. Bonds are for safety. Stocks are for speculation. Bonds are an important part of a well-diversified portfolio. They provide stability and predictability. And here's where you guys come in. You can decide 8%, 12%, 14%, depending on how much you invest. Under $250,000, 8%. $250,000 to $1 million, 12%. And I already know some of you guys want to put in over $1 million and just cash out of your stocks, and that's 14% return. You get paid monthly, or you could compound it. As you go up in the interest rate, though, the terms of the bonds go higher. So if you do want 14%, we need at least a 5 to 7 year bond. This actually helps us negotiate with the companies to get a higher rate. This is where you want to be. This is where you don't want to be. That's just an example from 2022. So how can you invest with us? You can go to our portal off of baluchcapital.com. Most of you guys probably want to schedule a call with me. You might have a couple questions. People actually have more questions about the paperwork more than anything else. Bonds is a pretty common concept for everybody to understand, and anybody that's bought a house has actually gotten money from a bond, so we're not doing anything different. Default rate's going to be less than 1% projected, and even if there was a default, we have a UCC filing on the whole company. We have a trustee that represents the bondholders, so nobody will really ever sign up for borrowing from the bond fund unless they know they can pay it, or else we're just going to take over their whole company. So it's kind of a built-in safety mechanism. That's pretty much it.